Welcome to Talking Property. Today my guest Louis Christopher and I are going to discuss the Sydney property market and what to expect in the second half of 2018. Louis, thanks for joining us.
Good to be here, Peter.
Louis, are we going to see a stronger finish to the year than what we saw in the first half of 2018?
It's early days yet to call it. It really is. There's still some X factors that could play out this year. One of them being what APRA actually does.
Yes.
And what we're currently dealing with the banks clamping down on monthly expenses. I think that still hasn't fully played out in the market. Then, of course, we've got the spring selling season, which is just around the corner now. And as you know, Peter, each year, when it comes to the spring selling season, we have a rise in listings. So what I wouldn't want to see, and I think we are going to see it, is a rise in listings during a property downturn. A seasonal rise in listings during a property downturn, that is. And that could mean more price falls as we get towards the end of the year. So I don't think the Reserve Bank's going to cut rates this year. But if we were to see the property falls start to accelerate in Sydney and Melbourne and perhaps even Brisbane, then I think the Reserve Bank of Australia will act and that may well mean a rate cut early next year, potentially.
Yeah, and that goes against common forecasts and consensus at the moment. A lot of people in the market have pushed their interest rate forecasts from an interest rate rise out to late 2019. But
yes.
The next step after that is people do start forming the view that the economy and the property market probably needs a cut to support it. Is that how you're reading it?
I think what many fail to really grasp is how much property prices, for better or worse, affect the economy and confidence in the economy. So there is that wealth effect and that feel-good factor that property prices can bring when the market is rising, and that can quickly reverse when you see a falling market, and particularly if we were to see more aggressive falls in the market, you would see a significant dent in consumer confidence.
So interestingly, Louis, even though we have record low interest rates at the moment, clearly the current interest rate setting is not a stimulant to the market at all.
Yeah, and that's really interesting. I mean, it's one thing about this cycle is that we're having price falls while we've got low interest rates. And it's the first time I've seen in a property cycle where the downturn hasn't been triggered by interest rate rises. This has been triggered, of course, by a restriction in credit, which is what, when you lift interest rates, that's what effectively happens.
Let's bring up your slide here, Louis, and look at the drivers of dwelling prices in Australia. Aside from what you've just discussed, is there anything else there that people should keep an eye on? And is there anything there that would trigger an upward movement in property prices?
Look, at this point in time, there's nothing that would trigger an upward movement unless we were to see APRA and the banks start to loosen credit restrictions. Now, they could do that. They could do that. If things start to get scary, and we're not at those levels yet, let's just be very clear about that. But if things were to get scary, they could loosen credit. They could make it easier for borrowers to borrow more once again. So let's not forget it. This is part of a policy that they've used, the banks used, where they didn't want to lift interest rates, but they had to slow down the housing market. Remember the boom days of 2015 and 2016 and the first half of 2017. You know, property prices were accelerating too quickly, and the powers that be felt they had to respond to try and reduce some risks in the marketplace. As it turned out, their actions actually created risks in the marketplace.
Aside from lending restrictions into the market, one of the other criteria that the government introduced to slow the boom down was a crackdown on foreign buyers.
Yes.
Now, we're seeing on the ground that foreign buyers of yesteryear are suddenly foreign sellers, where they're looking to liquidate the properties they've purchased off the plan. And we're hearing stories around Sydney of Chinese buyers not able to get money out of China to settle their off-the-plan purchase, and they're just walking away from their deposit. What's happening in that space there with the foreign buyers?
There's no doubt that foreign property investment has fallen from the peak levels. Indeed, the Foreign Investment Review Board updated the market recently, and it showed that in 2017, financial year 2017, foreign property investment fell by 2/3 from the previous year. Now, that said, let's just have some perspective on this. The percentage of the market which is operated, for lack of better words, by foreign property buyers, it's still only a fairly small percent. We're talking about 5% of the market, really. Foreign property buyers or foreign property investors are like any other investors, if not more so, that they're quite happy to hit the sell button and sell at whatever price the market's at. So they are far more responsive to market conditions.
What do you think will be the best performers in the Sydney property market in the second half of 2018?
Well, I still believe that the top end of the market's likely to hold from what we've seen in the first half. So these properties that are over $4 million are likely to continue to do well, and that is because the local economy here in Sydney is still going gangbusters. That is the reality.
So that's a price segment of the market. Is there a location segment that you like or a region in Sydney that you think is likely to hold better than others?
When we look at listings, it's pretty clear that freestanding houses in Sydney's east, the listings haven't risen dramatically. They've been holding at relatively low levels. So there's not a lot of new stock in Sydney's east. And we could also state that for the lower North Shore as well. For the inner west, on our numbers, we have seen a rise in freestanding houses as well as a rise in unit listings. So we're not as bullish on the inner west as what we are for the east. And when I use the word bullish, that sounds like we're really positive. We're not, quite clearly.
Yes.
But relatively speaking, I think the inner west will perform at the same rate as the wider Sydney average. That's what's been going on so far. The inner west has been really tracking the numbers of overall Sydney. And the underperformers, I'm expecting a little bit in the upper North Shore, in that $2 to $3 million price bracket, as well as parts of Sydney's outer west and Sydney's northwest as well.
Now, when can homeowners and investors, landlords that are already in the market, when can they expect price growth again in the Sydney market?
Well, it depends on the magnitude of this current correction. There's two ways this could play out. We could have a deep correction, but it's over in a relatively short period of time. Or we could have a modest correction similar to what we had where the market is stagnant for an extended period of time. I think the price action right now is suggesting that we're probably going to have that extended period where the market corrects, then basically flattens out for a long period.
Well, we have seen properties, interestingly, in the inner west, Louis, that sold for 2.8, 2.9 in the heat of the market, and they have resold recently in the mid-twos.
Yes.
So that is happening out there. There's absolutely no doubt about that.
Potentially what happened, that's not to say the overall market's come off by 30% or 20%. No. What happened was that you just had some very enthusiastic buyers at the peak of the market paying well over the odds for those properties. They just paid way too much for what they were worth, even for that point in time.
Yes.
And so they're the ones who are getting stung the most right now.
And I think people need to look past simplistic reporting and that a rising market's good for everyone and a falling market's bad for everyone. A market that is coming off and showing a bit more value, and let's face it, interest rates are at record lows. It does create a great opportunity for many people to take advantage if they see an opportunity in the market, doesn't it?
Oh, that's right. That's why they call it a buyer's market.
Yes.
So it becomes better for buyers, but buyers still need to be very careful because a perceived bargain today could be even more of a bargain tomorrow.
What I've never understood about real estate market as opposed to the stock market, though, is if there's a big correction on the stock market, the next day buyers come in looking to invest because there's opportunities aplenty. But the moment buyers see the property market coming off, everyone stands back and that feeds on itself, and you can miss some great opportunities. Let's face it, the best buying in Sydney was at the height of the GFC.
You're also taking a risk because the truth is that property prices can fall lower for longer.
Yes.
And it's very hard to time markets. And I think the important thing for buyers who are buying in today's market is they get a valuation, they take their time. If there's a good opportunity, by all means take it. Be sure that you buy within your budget. That's really important.
Well, the two biggest markets in Australia, Sydney and Melbourne, are clearly under pressure at the moment. I want to go back to that point about government intervention to keep things ticking along. And if Sydney and Melbourne do start coming off harder than the bureaucrats would like, I refuse to believe they're going to sit back and watch that happen. I think they will intervene to support the market, whether that's easing lending criteria or another interest rate cut. But I just can't imagine that governments would sit back, Australian governments would sit back and let Australia's two largest property markets go through a severe property crash, because
I think that's very unlikely.
No one would benefit from that.
No one benefits from that. The economy gets hit hard. We remember we've got an election next year.
Yes.
So the Libs will be keen to see a stable economy as we go into that, get closer to that election. So that really could affect the market or affect investor sentiment as we head into 2019.
Louis, the other thing that is frustrating is when you hear in the media comments such as Australian house prices. The Australian country is made up of many different markets. Can we just cut across here and have a look at what's happening nationally quickly? Louis, I think that chart just demonstrates there that there's markets within markets, and simplistic commentary should be best avoided, and you should get very specific about what drives each market you're looking at buying or investing in.
Yeah, no, I agree that, look, we don't have a single national housing market. We've got markets within markets. We always have. And I often come out saying, look, we've got a mixed housing market, because that's what it is. When you see one city in a boom and another city effectively in a bust, that's what you've got. Keep in mind, of course, there are factors at the national level that can affect the overall national market, such as rises and falls in interest rates and what we've been going through in more recent times in terms of lending restrictions. So we need to keep all that in mind, but there's no doubt that one can have very strong local economic factors that can override all that. And we have been seeing that now in the mining towns, where we're seeing now price rises in a number of these mining towns because commodity prices are higher. And there's little regard about lending restrictions at this point in time. You think about the banks will be pretty cautious about lending into a mining town. Well, prices are rising in a number of these towns now.
Excellent information today, Louis. Thanks for joining us as always.
Good to be here, Peter.
And thank you for joining us on Talking Property today. I hope you found Louis' explanation of property markets informative and helpful. Thank you.